All right, can you hear me? Does that work? I'm American, so I'm allowed anyway. Don't worry about it. Look, thank you all for joining us. Final presentation of the day, so we're almost done here. For those of you who have not, although it's unlikely, heard me, I am Alex Scanlon, Managing Director of Barton Gold. I'll take you through our presentation. The picture on the cover here is actually our shallow, sort of historical open pit mine at Tarcoola. Important notices, read it now, good. Look, really high level, who are we, what do we do, why do we care, why do we think you should care? We are a South Australian focused gold developer. We like the state because it's been overlooked for a very long time. It is the top copper producer, it is the Kazakhstan, it is a big uranium producer. This is Chile and Kazakhstan rolled into one state in Australia with excellent development prospects, great jurisdiction, great government support, but it's been very overlooked. It's got about 25% of Australia's known gold resources, but speaks for about 2.5% of its production. So we consider that highly underinvested. And what we did was we went in and we bought every single significant historical exploration and production asset in the central Gawler Craton. So we're right in the middle of the Gawler Craton, globally renowned geological precinct. On the west side of the highway, east side of the highway is BHP land, and in the future people will call the west side of the highway Barton Gold land. We've got about 5,000 square kilometers of tenements. We own the only gold mill in the region. So our strategy here has not been to run that mill back into immediate operations, but to step back, build up a much larger geological understanding of what's going on there around the immediate areas of interest. And really we're focused on doing three key things. One, building a large-scale baseload resource that can underpin our company for a long time. Two, looking for complementary high-grade mineralization in the neighboring Tarcoola goldfield. And then three, leveraging our existing mill to start staged, lower-cost, lower-risk development operations, go from 10 to 20 to 30 to 40,000 ounces, and then fund ourselves into 150,000 ounces with our Tunkillia project. So we've been making quite a bit of progress over the past few years. We IPO'd 3 years ago. We've had 4 resource upgrades in the past 16 months. We've just put out a scoping study for the Tunkillia project, which demonstrates that it is a very competitive gold producer at scale. We've just added 20,000 ounces to the pit floor in our open pit, and we are very well capitalized to continue going with about $10 million in cash. Our capital structure is very simple, just under 220 million shares on issue, no debt. Our options are linked to performance, so these get tested against very high bars over time. And what we've seen over the past 18 to 24 months as we've had this sort of pattern of really consistent, steady, incremental progress is a consolidation of our share register into the hands of sophisticated, high net wealth family offices, institutional specialist gold investors who are backing us as a development team. And this has been one reason why we performed relatively well. We have a very tight capital structure. We don't do generally marketed retail placements. So all the retail component of our register that you see in the 25% of that wheel, that's about 2,000 people that wanted to be in our shares. We were not a biotech company. We were a completely clean company. So everyone here wants to support us, and we've seen this in the response both from our institutional sponsors as well as from our retail investors who gave us a very, very strong response to our share purchase plan earlier this year. We can't go past the leadership, human capital when we think about capital. We have built a team that has, I dare say, getting close to or over 300 years of experience exploring for, permitting, financing, developing, operating, and optimizing major mining assets with a particularly strong pedigree in South Australia and in gold. Now, why have we built this team? Well, because our plan is to build a major gold producer, at least in the context that we think of. So our objective is to be a 150,000 ounce per annum producer on the basis of the assets that we have today. So again, we are looking at our primarily Tunkillia and Tarcoola assets for this. We are focused on open pit mineralization. It is faster, easier, cheaper, and safer to explore for, develop, and operate in an open pit environment than an underground environment, and you can react to things like inflationary cost pressures in ways that are simply more difficult in an underground environment. So we look at Tarcoola and Tunkillia. We have about 3,000 square kilometers of ground there. Tunkillia is where we have focused on building a large-scale baseload resource on a major shear zone, and Tarcoola is where we are now shifting our focus, looking for complementary high-grade mineralization and an historical high-grade gold field. This is where South Australia had its gold rush in 1893. The benefit that we have, and you can see some boxes there, is that we look at Tunkillia as an expansion project. We are not trying to jump from zero to hero, 0 to 150,000 ounces per annum. We are looking to leverage the Tarcoola project and our existing fully permitted mill to start small-scale operation. We already have a $200 million 2-year head start on permitting and building a mill. So we don't need a lot of ounces at Tarcoola and ounces we can scavenge around Challenger and the historical Central Gawler mill. We're very good at scavenging. We actually earn money selling gold. So we are looking to use Tarcoola and the existing mill as a step ladder to go over that obstacle that is building a whole big new operation. But when we do build Tunkillia, we will have the only 2 mills in the Central Gawler Craton, exactly 200 kilometers apart in a 500 kilometer long gold district, where we now have an ocean of junior explorers coming in around us and looking for mineralization, which will likely go through our mill in the future. So we like that. Why are we focused on bulk open pit? Well, again, it works better than everything everywhere all the time. If you can mine gold the way that you mine coal or iron ore, that is how you should mine it, if you are so lucky. We model ourselves, and we actually selected these assets in Tunkillia as a cornerstone of our long-term strategy on Capricorn. And when we were looking at Tunkillia for the first time back in 2017 and 2018, we started to see in the data some of the sort of patterns that were coming out in Capricorn's Karlawinda data. So Capricorn, if you don't know, they're a fairly significant Australian gold producer, about a $2.2 billion company. Way back in 2015, they acquired the Karlawinda asset as a 650,000 ounce asset. They grew it to 900,000 ounces and 1.1 and 1.3 and 1.5 million ounces. Today, it's grown to about 2.2 million ounces at 0.7 gram per ton. And in the Australian context, this is regarded as a very low-grade operation. But today, it is on a regular basis one of the lowest cost or the lowest cost pure play gold producers in Australia with a 5 million ton per annum plant. So we like volumetric efficiencies of capital and operating costs. We acquired Tunkillia at the beginning of 2020 as a 550,000 ounce asset and grew it to 900,000 ounces and 1.1 and 1.3 and 1.5. So we are very much playing follow the leader. We are following this model. We think it's the pathway to success. Looking at Tunkillia itself, one of the key things for us here was really challenging a lot of the historical assumptions. So when you look at this sort of ground area here, the dark blue area that you see in the resource outline is what we acquired as a resource. And we drilled that in the center and validated our theory that there is a higher grade zone. And then we smoothed the drilling to depth, and we extended the resources to depth and found new and parallel gold zones and chutes. And then we found multiple new gold zones along strike, and then we quickly converted those into new resources. So we've taken that resource up to about 1.5 million ounces as of March this year. Our recent resource growth over the past year or so has been about 500,000 ounces at about 15 Australian dollars per ounce. And that is a true all-in cost. That's not just the drilling cost. That's drilling, assay, labor, logistics, consulting, everything. So it's very, very efficient growth. And the point is that the mineral endowment of this system or systems is far greater than was historically recognized. We think there is more to go. There is another 25 kilometers of untested shear here. We are now starting to step out at the same time as we are putting this through the test of our theory that it performs very well at scale. So we have just published an initial scoping study, and we are cautious to emphasize it's initial, to test this premise of operating at scale, and it gives us a result of 130,000 ounces per annum at a very attractive cost of about $1,900 Australian all in. One of the reasons for that is sort of the geometry of the geology. So what you're looking at here is sort of the main 223 area deposit on the left-hand side, and the right-hand side is a cross-section through the middle of that. So what you're looking at here when you look at that cross-section is the area where the main ore zones come together. And you can see you've got this sort of quite vertical T zone there in the center, a T zone across the top and sort of the trunk of a tree down the middle. When you're looking at that mineralization in the fresh ore zone there, you're looking at 80 to 100 meters of mining width. So this is a football field long wide in terms of mining width. So big bulk, everything you see is ore through the mill. So this is how we get efficiencies of scale in a bulk open pit. When we think about the modeling, we cut off our modeling at 300 meters depth. We are not interested in going to 500 meters on 0.7 gram material. We just want to find the next deposit along strike. But when we look at that sort of 300 meter vertical profile, about 80% of the tons in grade are within 200 meters of surface, so we've got a bias to shallow. In that central zone, you can see some areas in our block model where the blocks are 2 to 5 and 5 to 10 gram per ton. So we have a bias of economics to the center. Really ideal for a starter pit. And then along the top there, you see that T zone in mineralization, and that is a supergene zone that's got about 250,000 ounces, and it can pay us while we are doing pre-strip for large-scale bulk operations. So these are three very attractive prospects for us. They've come together around one central tenet for us. We tested this resource around the idea of a 5 million ton per annum operation. We used conservative assumptions about power costs, crushing, grinding, capex. We wanted to see how the equation balances around scale. And what it shows us is a 130,000 ounce per annum operation at about $1,900 Australian all in, which would rank this operation today, were it operating this project, were it in operation today at number 17 out of 47 Australian companies, so bottom of the second quartile. We are now looking at optimizing this, bringing in some of those operating costs, bringing in some of that capital cost, and allocating that to expansion of the mine plan. So we see multiple opportunities to optimize this. One of the great opportunities or advantages that we have with this asset is that central zone. So when we look at a life of mine grade of 0.9 gram per ton, that central zone, that starter pit, has about 5 million ton of material at a grade of about 1.26 gram. And what that means is the first 12 months of material gives us 180,000 ounces in a 5 million ton per annum plant. So we're getting about $450 million in gross free cash out of the first 12 months of processing. So it is a huge return of capital that drives that 40% unlevered IRR, that 1.9 year payback. This is also why we're really keen to extend the life of this, but also supplement it with neighboring high-grade material. So again, we'll look at power costs, we'll look at the crushing and grinding costs and comminution opportunities here, but we think there's a lot of opportunity. We're also looking out along that shear zone. Very quickly, we are also looking next door. So again, we're 70 kilometers to the north. Tarcoola is the home of high-grade gold in South Australia. We've been building a new geological model while building Tunkillia resources. We've added ounces to the existing pit floor, and we've also just announced a new high-grade discovery, which we were hoping for in our new geological model. The pit's interesting as a lesson for the potential value near surface that we have here. What you can see is a very shallow pit that produced somewhere around 35,000 ounces of gold during 2017 and 2018 to our mill. We've just put 20,000 ounces in the immediate pit floor, so this is all within about 60 meters of surface, so to speak, in the pit floor. So we don't expect this or need this to be a big deposit, but it is interesting because when we look out across that historical gold field, what do we see? Well, this is the model that we published in November of last year. And when we published it, we had 6,000 ounces in the mine floor, and we had one interesting drill hole in Warburton. We did 10,000 meters of drilling, and we've come up with a new gold zone at Tolmer. So this model basically showed us for the first time in 130 years of high-grade mining in this field what the subsurface structures actually look like. And it's the first time we can see all of the known historical gold occurrences in a consistent structural framework. So this is essentially a target map which we are now validating and refining, but we've already had an early success, and you can see with Tolmer here, things like 14 meters at 1.4 gram or 4 meters at 25. I'll take that. We're looking for multiple shallow, high-grade open pits. The existing mine can feed our current mill. That material will go through Tunkillia and give us more of those starter pit style returns as we go through the life of mine. So we've been extraordinarily busy for the past 3 years. You can see a lot of green check marks on here. I promise you that's all good. We sell gold. We do not do one big jump every 3 years. We are the steady, reliable, incremental progressors of our assets. We move forward, we tell you about it, we're an open book, we generate capital, we dilute a little bit, and generally perform pretty well. We think consistent progress is the pathway to success. We have an extraordinarily strong platform. It is growing quickly. We have a great leadership team. We're well capitalized, and we have got a lot of news coming up. So As always, we're always happy to answer questions. You can reach out to us anytime. Thank you for listening to me.